I am so over the people that are out there on social media that are like, I'm a 7-figure business owner. I'm an 8-figure business owner. I don't care. I don't care how much your top line revenue is. I want to know what your cash flow looks like. Your top line can be whatever you want, but if you're in debt, if you actually are negative on your balance sheet, that's what matters. Have you just had a record-breaking month and you wonder where all of the cash is gone? Have you gone to process payroll and then had to check your bank account real quick to make sure that there was actually enough cash there for all of the payroll to clear? Have you had the best quarter of your life and you actually feel like you have less cash now than you had a few months ago? This is a common situation for business owners of all sizes. And today we are going to break down what your financial blind spot is in your business and why it may be bleeding you dry until you figure out what it is. I'm Melissa Franks, the host of the Opt-in podcast, and this is where we go from surviving to thriving in business. You may be wondering right now, how can your business be growing and dying at the same time? Have you ever felt that way? I'm sure that you have. If you've been in business for any length of time, as you grow, you think, I'm going to have more money. I'm going to have more freedom. I'm going to have more flexibility. And what often happens is you realize you actually have more expense. The bigger you get, the more it costs to run the thing that you're actually building. And at a certain point, you kind of say, well, what is the point? Maybe I should shrink back down to where things are really, really good because this is hard. This is uncomfortable. And the reason for that is because you have a blind spot. You have something that you're not looking at. And that is something that we are going to address today. Now, this is a continuation of the conversation that we have been having over the last few weeks. A few weeks ago, we talked about if you are the owner or just the employee in your business. And having a clear financial picture of what's happening in your business is actually a key pillar to owning the business, to being the owner, the founder, the leader, the CEO. You pick your title, whatever you want. The end of the day, all of those roles require you to have a very clear financial outlook and picture of what's happening in the business so that you can make the decisions that matter. It's not just about running the business. It's not just about getting new business in the door. It's not just about servicing clients. And I want to be really clear with you. It's not just about revenue because frankly, that's a vanity metric. I am so over the people that are out there on social media that are like, I'm a 7-figure business owner. I'm an 8-figure business owner. I don't care. I don't care how much your top line revenue is. I want to know what your cash flow looks like. I want to know what your margin looks like. Those are the sources of truth about the health of your business long term. They're the things that actually tell us what's happening in the business. Your top line can be whatever you want, but if you're in debt, if you actually are negative on your balance sheet, that's what matters. Not these vanity metrics that you're running around the internet proclaiming are great. The other thing that's also happening, because I just want to say this once so that we can keep moving, is if you are comparing yourself to other people out there in the world that are speaking about their numbers on the internet, I want to tell you what they're actually doing is giving you an aggregate number. There's more than one, more than 5 that I know personally that have come out on the internet and said that they are 8-figure business owners. And you know what they're talking about? They're talking about the 10 years that they were in business, the 15 years that they were in business. When you add it all together, they create 8 figures. They're not saying that in one calendar year, in 2025, I made 8 figures in my business. And those misleading things can send you down a dark spiral. They can have you chasing the wrong things, and they can have you ignoring the blind spots in your business. So what are those actual blind spots? Let's break it down. There are 3 of them that I'm going to talk about today. Now, if I was a CFO, if I was a CPA, if I was a tax advisor, I am sure that there are more financial blind spots, but as an operations leader, these are the ones that I care about. These are the levers that we pull often, and these are the ones that you don't need a highly specialized financial analyst to be able to point out and help you calculate. The first one is revenue versus cash timing. Being profitable on the P&L while cash is trapped in receivables, which means the money you are expecting to get in, aka payment plans or monthly recurring, right? It's the cash that's caught up in inventory. It's the cash that's caught up in expenses that you've already paid into the future. The gap between booking revenue and collecting it is this revenue versus cash timing. And it's really, really important. You can declare, I generated $100,000 in revenue, but if you realize that cash over a 6-month horizon, your financial picture is quite different. The second is that your margin is being diluted and nobody is watching it. This is the most common. I would say that the majority of business owners that we speak to when we talk to them about the margin in their business, they don't know the answer to that question. Just yesterday, I was on a sales call and the individual owned a business in the fitness space. And we were talking about all of the financial topics and concerns that are in the business right now. And the question was, what is your margin? And it's good. That was the answer. And that can't be the answer, because the reality is that maybe it's good in some places. Maybe it's 30, 40, 50, 60% in some places, maybe 4% in the other places. And those are the things that you want to watch out for and understand. So margin dilution is discounting, scope creep. It's rising costs that quietly erode margin and you're not really paying attention. This can be on a per job, per client, per product basis. Your top line revenue is climbing, but your costs are actually outpacing the revenue coming in. And that's when your margin dilutes. And then the third one that we're going to talk about is the owner's blended blind spot. This is personal draws, commingled expenses, founder salary that isn't a real line item. It is tax strategies that you're doing in the business that actually take business cash out to employ some tax strategies. This makes it very difficult for you to see true profitability unless you're accounting for them in the right way. So what I want to talk to you about is what each one of these looks like day to day, why it hides in plain sight, and the number one that would have exposed it earlier. So this is what we are talking about right now. The revenue versus cash timing. Depending on your business model, you may be able to see or account that you have generated a certain amount of revenue in a month, and then that money is actually going to hit your bank account over a period of time. This is most common in professional services businesses. It's most common in coaching businesses, right? Those businesses contract with an individual or a business for a certain scope, for a certain amount of time, and for a certain amount of money. And then generally, unless it's paid in full at the very beginning, that's paid over time. So what you do is you realize the revenue. You have a sales conversation, you close a sale, and you say, and you do it over and over and over and over and over again in a given month, and you say, I generated $100,000 in revenue this month. And the reality is that while you generated $100,000 in revenue, you may have only deposited in cash $10,000. And that over the course of the next 10 months, you get $10,000 a month, every single month. If you are spending money like you have $100,000 cash in hand, and the reality is that spread over a 10-month horizon, you know what's going to happen? You're going to run out of cash. Being very clear on cash timing in your business is more important than having a clear idea of your top line revenue. The one thing that we always install in every single business, if it does not exist, is a forecast. And that is simply, this is how much revenue we plan to generate every single month. And then this is how much cash is coming into the business every single month. The additional thing that we then work on behind the scenes is a budget. So if this is how much cash is coming in, this is how much money we plan to spend, and then you get your net profit. And we create a forecast. We predict what's going to happen in the future so that we can manage expenses. Here's what I mean. If in this example we just talked about, you generate $100,000 in January, and that $100,000 is going to come across the next 10 months as $10,000 in cash, and it's your very first business, and that's all that you've got, right? Then you know in January, you can't spend any more than $10,000. You know if you sell nothing else in February, you can't spend more than $10,000. So if all of a sudden you've made $100,000, and in January you're like, you know what I'm going to do is I'm going to hire somebody, and their salary is going to be $5,000 a month. Well, that means that you only have $5,000 a month in cash left. That's why the cash matters. That's why it's important for you to look at it, because in your head, you're like, well, I'm only going to be paying them $50,000 and I just made $100,000, so we're fine. But you want to do the math. And as you continue to generate revenue, you want to continue to calculate what the cash timing is. Creating a forecast so you know how much cash you will have every single month will help you determine what you can invest in, what you can spend money on, and how much liquid you have to play with. Now, the second thing, and this is where the budget comes in, is this margin dilution that nobody is watching. And this is when you declare that you're going to sell something for $100 and then you keep giving it to everybody at $50. So when you sold it at $100, maybe your margin was 30%. And as soon as you sold it at $50, it was no longer at 30%. Maybe it was at 10. Maybe it was at 5. That discount, the discounting of the product price, will dilute your margin. Exactly the same as if you provide more than you estimated to do. So cost of goods sold is really just how much does it cost for me to do the thing, period. And if you're a service provider, it's how much does it cost to do labor, and then like what are our basic operating expenses. If you're a product, if you're selling a product, then how much does it cost, like landed, to get the product into the US and ready to sell, or whatever country you're in. So once you know your cost of goods sold, then you know what you're actually delivering. So if we look at a services-based business, let's say that you're selling $100 worth of services, and that means that it's 2 hours of somebody's time. Well, if all of a sudden you ask somebody to work 5 hours, you have to pay them for the 5 hours. Right? Now, the customer's not paying you for the 5 hours, but you've got to pay somebody else. Scope creep, margin erosion. It's when you end up in the red. The other is that when your costs slowly rise. Here's what I mean. Let's say that you started with a very simple tool stack. You had Gmail and you had maybe AI, and that was just kind of what you did. And then as you continue to grow, you were like, hey, I need a Canvas subscription, and I need to start recording my calls, and I need to pay for Zoom. And before you know it, you were paying $20 a month for your subscriptions. And now all of a sudden you're spending $1,000 a month for your subscriptions. Well, those are rising costs. And those are the silent killer. Out of all of the things that dilute margin, the one thing that does it the most without you paying any attention is the small investments over time you're making in the business that will actually add up, and they come in faster than you think, and they will eat away margin. You know logically if you discount something that you've lost margin. You know logically if you're going to give something away for free, you've diluted margin. But when you are ignoring what you're spending money on in the business month over month, that will erode your margins faster than anything else. It's harder to fix, it's harder to diagnose, and it will get you in the red seriously fast. This is the one thing that we see most often. That's why we do that budget step. We do the cash forecast, and then we come back in and we're like, well, how much are you spending every month? Well, you know you're spending more than you're bringing in. And then they're like, shock and awe. And then we go through and we figure out, we make some really tough decisions about where we're going to cut. And sometimes it's that we have to cut headcount in order to get ourselves back in line. And then the last thing is like, hey, we all started a business so that we had flexibility and we had cash and we had the ability to employ tax strategies and do all those things. But also, you have to be honest with your financials. So if you are taking owner's draws and you are taking money out of the business that is not a W-2 recurring paycheck, you have to record it. You have to have it documented in your P&L. You have to have it documented in all of your financial reports. And that forecast I talked about with the first blind spot, you have to calculate how much you're realistically getting paid. And the reason that I say that is because that's a part of real expense to the business. If you're planning to employ a tax strategy, let's say that you're planning to invoke the Augusta rule where you can rent your primary residence out for 14 days for business purposes, you have to put that in the forecast and plan for it. Because when you go to take out the 5-figure number associated with the Augusta rule, if you haven't planned to be able to do that, then you don't know that you have enough cash on hand to be able to run the business and also pay yourself that way. And so all of these things need to be transparent. You need to be honest with yourself about how much money you're taking out of the business. I know this one's going to sting because nobody wants to talk about it. Nobody wants to talk about how much they're getting paid, how much they're pulling out, how they're doing all the things we all think is a dirty secret. Listen, everybody does it. So just be honest about it. Just put it in your reporting. Just have it in plain sight so that you can address it. Because the reality is if the business can't afford for you to invoke the Augusta rule, then you don't invoke the Augusta rule. The good and the bad with you owning the business and being able to take money out however you want is sometimes you can't take money when you want. because you want to keep the business long term. And so just get clear and transparent about it so that you can make informed decisions about what to do with the cash in the business. And if you don't have enough cash, then it tells you you need to go back out and sell. There are periods in your business where you're going to be on a high, and then you're going to contract. And the danger is that when you're at the high, you can afford all of these crazy expenses. You can pull cash out of the business. You can do all these things. When you drop back down unexpectedly to a low point, that's when it really matters that you've been managing your expenses. So instead of going into panic mode when you drop to a low point and then trying to cut like crazy in order to make sure that you stay positive, just be smart about what you're managing when you're at the high. Just be really, really smart and ask every time, like, is this something I need to spend money on? Does this make sense? Does this discount make sense? Should we give this stuff away for free? Continue to ask yourself, be as ruthless with decision making at the highs as you are at the lows. Now, smart owners miss these things all of the time. And primarily it's because you didn't start the business to run the business. So these are things that you didn't think that you needed to think about or know. You just were like, hey, if I just keep making money, then everything's going to be fine and we're all going to be copacetic and good. And I get that, but you actually have an asset. That's what a business is. It's an asset. And like, if you think about all those wealth managers out there, all those asset managers out there that are paid a whole bunch of money to manage those things, you've got the same situation here. So you should treat it as seriously as they do other people's money and other people's assets in capital markets. Am I right? So you built the business on a sales or a product or a solution instinct, right? You built the business based on, if I give this thing out, I know people are going to buy it. If I provide this service, I know I'm solving a problem. I've built the better mousetrap. I've done all the things, right? That's all sales, product, innovative, disruptive. You didn't build the business because you're like, you know what makes sense? This is a financially sound model, and this is going to generate healthy cash flow. And unless you are coming at me from Cody Sanchez's world where she's buying boring businesses and she's actually evaluating everything from a financial blueprint and like how much cash flow and how it's going to diversify the portfolio, unless you're coming to me from there, you are like every other business owner that I know that you started the business because you had a mission, a purpose, a product, a whatever, and you knew that you could make money on it. You did not come in and say, I need to understand, I need to do cash flow analysis and I need to do a forecast and we need to sit here with a budget. That doesn't happen. And there's nothing wrong with that. In fact, I think that in order to take the leap and the risk, you need to not have financial literacy. Because those that are well-versed in finances know that it is a crazy bet to go try to start a business and live off of it. So most people that are highly financially literate are also risk adverse. So congratulations, you actually have the right profile to start a business. It just comes at a cost. And so what that means is that the financial function gets the least amount of attention. It's not where you're strong. It's not where you have information. And it's not because, and primarily you didn't know that you needed to pay attention. You're so focused on selling. You're so focused on fulfilling. You're so focused on keeping people happy and your social media and your brand and like all of the other things that are out there that you didn't spend a bunch of time digging into the finance and understanding what was happening, right? And you may have a bookkeeper. You may actually even have an accountant that files your taxes. And it's not their jobs to do these things that we're talking about. Your accountant is not going to build you a forecast and a budget. They're not. What they are going to do is they're going to file your taxes for you. They are going to generate financial reports based on what happened. They're going to be telling you what happened in the past. They're not going to be talking to you about what we intend to have happen in the future. Both bookkeepers and accountants, they report history. You're concerned about present and future. There is a mismatch. And so the blind spot remains even though you have financial professionals on your team. Nobody is telling you what's about to happen. Nobody's working with you to identify the actions that you're going to take so that we can determine what's next. And that is the gap. When you do not know where you are headed, when you do not call a destination, when you do not have a clear map of what that's going to look like, you end up in the wrong spot all of the time. And often you end up in the wrong spot, which means that you're in the red and you're out of cash and you're freaking out. You also may, and many people have this attitude in the beginning, have an attitude of we're growing, so everything must be fine. Growth can mask margin problems for a really long time. And the longer it masks it, the harder it is to fix it. So do not trust that your top line number is continuing to grow so everything else is going to be fine. If you are not paying attention to how much cash flow you have in your business and making decisions about how you're using it, you will run out of cash. Eventually, you will. I've seen it happen over and over and over again. So we've already talked about the solution. You need a simple financial dashboard. That's it. That's it. And it doesn't need to be a ton of things. If you have financial reports that are already getting created for you, then you have enough information from your historical profit and loss reports that you can see what your monthly expenses look like. How much money are you paying in payroll? How much are you paying in contractors? And then everything else. You can also see how much you're paying yourself in owner's drafts, right? If you're being honest about that. So what you want to do is you want to understand what we refer to as operating expense. How much does it cost to run the business on a monthly basis? That's all you need to know. You can get those from the reports, okay? You don't need to do anything more complicated than that. And then the numbers that you need to know are your cash runway. So that is your projections, that forecast that we talked about, where literally you can create a Google sheet by month and you can say that this is how much cash I expect to come in every single month based on the sales that I've already done, right? Or the future sales that I think are going to happen. So cash runway is one. Gross margin percent, that's why you need to understand your operating expense. Accounts receivable aging, so that again is tied to cash runway. So if you have people on payment plans, if you get monthly recurring revenue because you're a service professional, you need to understand how the payments are going to be coming in and at what timing. Okay. And OpEx, so burn rate, like we talked about. And those are it, really. That's all you need to know. And then every week, what you want to do is you want to do a number check-in. Did something change? Did we lose an account? Did somebody cancel? Did somebody default on payment? Like, what's actually happening from our cash position? And have we added any expenses over time? And then once a month, you take a deep dive. You look at the reports that come in from your financial professionals, you compare them to what you had, and you say, has anything changed? Is anything different? Do I need to dig in? All of these numbers you can get through doing simple calculations. You primarily get them from the reports that either your bookkeeper or your accountant gives you. You don't need a CFO or a COO to do this. Heck, at this point, you can probably even provide those reports to Claude, and it can help you get the numbers so that you can at least see what's happening. And then what I want you to do is install this mechanism in all of your leadership teams. I want you to ask, what did this actually cost us to deliver? All in. When we did this thing, how much did it cost? And then I just want you to compare it to the revenue. Every time you go to make a decision, I want you to really start to get this owner's mindset of like, how much investment do I have to make before I realize the gain? If I do this project and I have 5 people on my team working on it for 6 months, this is how much it's going to cost me. Am I going to get the 2, 3, 4x return on the back end? Cool, we're good. If I'm not, is it even worth it? Start asking those questions and get your team into a frame of mind where they're actually considering the value proposition. We're going to generate this much revenue, but it's going to cost us this much to do. Does it make sense for us to do it right now? So revenue tells you a story, and it's one that you should pay attention to. But cash and margin tell you the truth. Revenue tells you if you're growing. Cash and margin tell you if you're growing profitably. And that is the key. No matter what you want to do with your business, you want to take out more owner's drafts, you want to give the business to your kids one day, you want to sell it one day, whatever. What everybody cares about is cash and margin. Revenue is interesting, but those other two things are truth tellers, and that's where you want to focus. Now, I want you to really consider that when you step into this role and you're looking at these numbers, how you'll take decisions differently. I want you to consider how you're going to be steering and running your business differently. I want you to take that fear that you have right now about, I'm not good at finances, I'm not good at math, and I want you to tell it to walk away. Because you are the owner of the business, you have command and control, you can master this without needing a professional in your business. I hope that this was helpful to you. I'm having a ton of financial conversations. I think that maybe it's like summer slowness. I'm not sure what's happening, but we are talking about finances with almost every single new person that's coming in the door right now. So I thought this would be a great time for me to give you just a couple of tips and tricks about things that we look for, about conversations that we are having, And if this resonated with you and you think there's another business owner in your life that it would help as well, please like, share, comment, review, etc., etc. It's how we continue to do this for you every week. And until next time, friends, please know that you are wise and you are strong and you are capable, and I believe in you.